Before I start sharing free analysis and the Alert with Ninja strategy, I'd like us to have a little chat about risk management. That is why today's seminar will be focusing on understanding risk management technique. My name is RJ, and I'm passionate about teaching traders how to apply Hello of Ninja principle to improve their trading skills. Whether you're trading stock, forex, cryptocurrency, metals, energy, or any other asset group, in general, trading is the art of putting your hard-earned money in the market at the risk of losing it without fear. Other circumstances where you have an edge, the chance or probability of price action going in your favor while following strict risk management rules. Trading is not a quick get rich scheme. Rather, it's about mastery the technique to preserve your capital, where you learn how to manage risk and preserve capital. Profit will come naturally, and when you focus on making profit, you will end up losing. What it means to be a trader. In trading, losses is part of the business and must be accepted as a cost of doing business. Business has revenue and cost, and cost is always going to be required as long as the revenue is larger than the cost. At the end of the day, it is still profitable. Risk management is overlooked by many traders, even me when I first started trading, due to the unwillingness to take losses. Poor risk management is one of the reasons for failure of many traders and over leveraging inappropriate position size. Now we have a problem that need a solution. And the solution is component of a solid risk management. Component of a solid risk management. It is very important for you to write these five components down and you must discipline yourself with it. One is trade journal. This is what I'm using now. I've had a lot of trade journal in the past few years, but this is the one I'm using currently. And it's just a trade journal. This journal I'm working right here is my life journal. You know what I'm saying? All the things I want to achieve is inside this journal. You need to plan everything down. You don't wait until you have the money. Plan it now. Now is the time. You know what I'm saying? Now is the time. So you need to have a trade journal. So the second one is constant risk ratio. It is very important for you to have a constant risk ratio because when you're risking, the rules I gave myself is that I don't risk more than 2% of my capital. You know what I'm saying? When I'm risking a trade, I don't risk more than 2% of my capital. I can start with 1% or zero point 0.5, but I don't risk more than 2%. So you need to discipline yourself with this stuff for you to be a successful trader. The third one is minimum trade risk to reward should be 1 into 4. When you're trading and you place a trade, you risk $10. You should be expecting $40 in return. If you analyze the market and it's not giving you $40 in return for the risk of $10, don't place the trade. You know what I'm saying? It is not worth risking. So you need to have at least 1 into 4 risk to reward. The fourth one is you need to create a risk-free trade. For example, you place a trade and the market is not yet hit your target expectation and you're already in profit of $40. You can place a new trade. That is called risk-free trade. The last one is target. Maximum target for the month should be 50%. You know what I'm saying? Don't ever and ever have 50% as target, or you should be expecting 100% as target for the month. You will blow up your account. In a very short period of time, you'll be like, oh my God, the market. You start blaming the market. You start blaming the government. Start blaming your sisters. Start blaming people that don't even know about trading. You start blaming them. Why? Because it is your fault, but you don't want to take the blame on yourself. You said, oh, people are watching me as I'm placing to trade. That's why you blow up your account. Take full responsibility of everything. You know what I'm saying? So you will know where the problem came from. And if you discipline yourself with these five components of a solid risk management, you will be successful in a very short period of time. Now, let's move to the list of loss to prevent from. On this side, we have what is called amount of equity loss, and on this side, we have profit needed for equity recovery. You lost 20% of your capital. Profit needed for equity recovery is 25%, which will be very hard for you to recover from. You know what I'm saying? So you need to understand that the more you lose, the more difficult it is for you to recover. You need to put it at the back of your mind that the more you lose, the more difficult it is for you to recover. Just remember that word, how you just said, the more you lose, the more difficult it is for you to recover. Then you back up. You want to place trade that will actually affect you for the rest of the month. You know what I'm saying? Because if you lose 25% of your capital, there's no way you will actually hit your target for the month again. It's gone. You know what I'm saying? So that is the first one. When you risk 60% of your capital, this was me when I first started trading. Yeah, this was me when I first started trading. I always start with at least 60%, 90%. You know what I'm saying? To gain at least 100% within a week. This was me. So I risked 60% and I lost. Profit needed for equity recovery will be 150%. You know what I'm saying? Profit needed for equity recovery is 150% if you're risking 60% of your capital. At the end of the day, I'll start blaming the government. I'll start blaming the market that somebody's watching how I place my trade. That is how I blow up my account. It's crazy, and it was my fault. The person that helped me find out that it was my fault was Jim Ron. Yeah, Jim Ron. He really helped me with that. You know what I'm saying? He made me take the responsibility of everything and see where I actually lose guard, which is risk management. I only have the skills, I don't have the risk management. So that's what I'm telling you. If you're new, that you're just starting out there, you need to focus on risk management and be good in risk management because that is the 100% way to be successful in trading. You know what I'm saying? When you risk 90% of your capital and you lost, the profit needed for equity recovery is 800%. That is why I'm saying that the more you lose, the more difficult it is for you to recover. The more you lose, the more difficult it is for you to recover. Just put it at the back of your mind. How you said, the more you lose, the more difficult it is for you to recover. So you won't misbehave. You will follow the rules I gave you today. It is that simple. Yes, it is very, very simple. Get the journal. It's simple. Follow it, following the rules. It is simple. I'm always here for you. Just follow the rules. Keep in mind that analysis and trading represent two different skill sets. Although you may be a talented analyst, that doesn't mean you'll be a successful trader because analysis is a skill set while trading revolves around risk management. You're welcome.